The upcoming EU oil embargo on Russian crude oil and the accompanying G7 price cap, they have the potential to drastically backfire. Vladimir Putin is not going to allow Russian oil revenues to come under attack without a fight. And this showdown between East and West could lead to skyrocketing energy prices, soaring inflation, and deep recessions across Western nations. Needless to say, there are major implications here for the global economy, as well as for gold and silver. And that's what we're going to get into in today's video, so let's get to it. Hey everybody, Smart Silver Stacker here. Thanks for tuning into today's video. If you enjoy it and you get some value from it, please do give it a big thumbs up down below. And today's video is brought to you by SD Bullion, so don't forget to check them out with the link down in the description. So as early as March of this year, Russian Deputy Prime Minister Alexander Novak warned that a Western ban on Russian oil could drive global crude prices to $300 a barrel or more. But that did not stop the EU from adopting its sixth package of sanctions against Russia in June. Sanctions that included a complete import ban on all Russian seaborne crude oil and petroleum products. Now, the ban is right around the corner. It's scheduled to go into effect on December 5th, followed by a ban on refined petroleum products on February 5th, 2023. But this embargo, it goes beyond a mere ban on imports. In addition, EU and UK companies will no longer extend insurance to Russian oil tankers, and this is a move that could lead to a severe global oil shock. And that leads us to the other part of this story, the G7 price cap on Russian oil. While the US, the EU, and the G7 nations do want to hurt Russian oil revenues, they kind of want to have their cake and eat it too. Russia is the world's second largest exporter of petroleum following Saudi Arabia, and disrupting their oil exports completely would cause global energy prices to skyrocket, followed by massive inflationary pressure, a situation Western politicians want to avoid at all cost. And that's where this idea of a price cap on Russian oil comes in. The idea here is that so long as oil tankers sell Russian crude oil below a threshold set by the G7, they can continue to do business with the West. That way, Russian oil revenues are decreased, limiting their ability to fund the war in Ukraine, and at the same time, their petroleum continues to flow to world markets, and a supply shock and accompanying surge in prices is averted. Now, this sounds good in theory, but the viability of this plan seems somewhat questionable. One major challenge is that EU nations can't seem to agree on what price the cap should even be. Countries like Cyprus, Greece, and Malta, whose large shipping industries stand to lose significant revenue if Russian cargoes are obstructed, are calling for a cap in the range of $65 to $70. In this scenario, the cap will largely be symbolic, as Russian crude, also known as Urals oil, is already trading in this price range. Other, somewhat more hawkish EU members like Poland, Lithuania, and Estonia believe that the $65 to $70 range is too high, and will allow Russia to continue to reap significant profits, as Russia's cost of production is close to $20 a barrel. And Ukraine and Zelensky, of course, most hawkish of all, they want a price cap in the $30 to $40 range. But here's the thing, all of this bickering over what price to set the cap at, it could be meaningless anyway, when viewed in the context of a Russian response to the price cap. In September, Vladimir Putin warned that if price caps were imposed on Russian energy, Russia would halt energy exports to the West entirely, saying, "We will not supply anything if it is contrary to our interests. No gas, no oil, no coal, no fuel oil, nothing. Those who are trying to impose something on us are in no position today to dictate their will. They should come to their senses." And on November 24th, Kremlin spokesman Dmitry Peskov reiterated this position, stating, "As of now, we stand by President Putin's position that we will not supply oil and gas to the countries which would set and join the cap." Now, this type of rhetoric, it should send a chill down the spine of residents of the EU, where already sky-high energy prices are the major contributor to the record inflation that is ravaging EU economies. Now, possibly, G7 member states might have thought, well, if Russia bans energy exports to us, we can always just purchase them through a third-party intermediary to get around that. But yesterday, it was revealed that the Kremlin is drafting a presidential decree that will prohibit Russian companies and any traders who buy Russian oil from reselling it to any nation or entity that participates in the price cap. And if Putin is successful in this gambit to counter the embargo, it is possible that we may see energy prices in the West or even worldwide surging in the very near future. And it's hard to imagine what would stop Putin from implementing this plan. At this stage of the game, the EU needs Russian energy much more than Russia needs the European market. Moscow has found ample demand for its energy in Asia among its BRICS partners, becoming the top crude supplier for India and going neck to neck with Saudi Arabia for the position of China's top supplier of oil. And both of these Asian behemoths have benefited significantly from this arrangement. They have been able to secure discounts on the Russian oil that they are importing, and cheap energy is a potent tool for gaining economic advantage and growing a nation's GDP. And it's for this reason that it seems neither China nor India will have a strong incentive to participate in the cap, as they won't want to jeopardize their newfound source of low-cost energy. Although the outcome in Asia does remain somewhat uncertain, and there are reports that Indian buyers are attempting to stockpile cheap Russian crude oil ahead of the December 5th deadline. China, in particular, will want to retain its access to Russian energy to be put to use when it reopens its economy following strict COVID-0 lockdowns. When this will happen exactly remains uncertain, but recently there have been reports of significant unrest across China related to the lockdowns, and this may pressure the CCP leadership to reopen sooner than previously anticipated. And this fact, that the timing of a reopening Chinese economy and the accompanying significant increase in Chinese energy demand may coincide with disruptions to global energy markets brought on by the EU embargo and the G7 price cap, you can see how there is a perfect storm brewing for much higher global energy prices ahead. Now, it may be that the EU and the G7 decide to go with a price cap at the higher end of the proposed range, say $70 a barrel. In that event, it will largely be a symbolic gesture, and perhaps Russia will not feel the need to escalate the situation and disrupt global markets any further. But if they go with a lower price cap, or perhaps if Russia simply wants to send a strong message regardless of the level of the price cap, we may be in for some very challenging times ahead in 2023. JP Morgan has warned that oil prices could go as high as $380 a barrel in a worst-case scenario involving Russian crude production cuts. And I think it's safe to say that if oil gets anywhere even remotely close to a price target like that, the outcome will be disastrous. Inflation will spiral out of control to levels unthinkable by today's standards. Central banks will be faced with a choice to hike rates drastically and fight inflation, inducing the worst recession in recorded history, or to simply allow their currencies to be hyperinflated away. And in either scenario, the price of just about everything, especially tangible commodities like food, fuel, and precious metals like gold, silver, and platinum, will soar out of control. Now, it's not a guaranteed outcome by any means, and hopefully, cooler heads will prevail. But with heads of state practicing economic brinksmanship on this level, it is best to be aware of and prepared for any outcome. So let me know what you think about the price cap and the embargo. How do you think it's going to play out? Leave me a comment down below to let me know what you think. Thanks for watching, everybody. Stay safe and happy stacking. I'll catch you next time. Smart Silver Stacker, out.